I'd say we are pleasantly surprised. The resilience and the strength of the Spanish economy vis-a-vis the Eurozone is remarkable. It is true, and we have seen it sustain now for last year, and I think looking into 2024 this year, it's going to be the case. We have had recovery from the pandemic that is still a real fact. We had obviously big benefit from tourism. GDP associated to tourism grew by 6.9% last year. We are at the highest level of visitors and money spent by visitors, with foreign visitors in Spain, and that's likely to continue into 2024.
Are there any areas of concerns when it comes to the Spanish economy that you're looking at? Some talk about potentially the housing area, youth unemployment that is structurally high in Spain. Is there anything that is keeping you awake?
Well, there are many things we need to do in Spain as in other countries. So there's always areas of focus for us, clearly. But when I look at the real estate market, this is a market that is in much better balance than it has ever been. Prices are still below the level of 2008, and we're still building actually fewer houses than we need. So the problem is not of a bubble in the real estate market, it's quite one of affordability. And finally, the labor market is doing very well. We actually created almost 4% growth in the total labor force in 2023, which is again quite positive.
Can I ask you about the windfall tax? Because of course Spain was one of the countries where it was put in place. Now it will run into a third year, so all to 2025, a levy of 4.8% on income from interest and commission. So I know CaixaBank was very vocally against this levy. How much is it impacting things for your business?
Well, it's a charge that last year was close to 380 million, and for us it's a bit more than 1% of our shareholders' equity, so it's bringing down our return on equity by 1%. This year is actually going to be more because revenues have grown in 2024, so it does have that impact. Obviously, to have a banking tax is a decision for Parliament, eventually the country, and we have to respect that. The points we've made with respect to the banking tax in Spain relate to the fact that whether it is fair or not, and it is predicated on the basis of banks making too much money, and the reality is that we're making a lower return on equity than the average of other industries. We're just making more than what we had for the last 10 years because we had a time of exceptionally low rates. So it's not necessarily fair, and on the other hand, it is distorting competition. Foreign banks are not subject to it, smaller banks are not subject to it, non-bank financial institutions are not subject to it. We're competing with all these players, so it is not fair, I think, for us to be taxed and others doing the same function not.
And how about the valuation of European banks in general against US banks? Spanish banks in particular, some of the best returns in the industry. Your own bank return on tangible equity of 15.6% last year, 60% payout ratio, and yet European banks are still unloved compared to US banks. So what needs to be done in your view?
It's a big question. I wish I had the answer. When you look at the cost of equity that is implied in the market valuation of banks in Europe, it's around 16%, 1.6. That compares to an average of 8% for the index, no? So we have double the cost of equity as a bank. That doesn't make sense. When you look at fixed income markets, look at how we fund in the markets in subordinated debt, senior, even additional tier one, those markets are working properly and spreads are in line with ratings and in line with spreads in other parts of the world. But when you look at shares, then this is completely broken. So something is obviously wrong, and I think the first thing we need to do is acknowledge this is, to me, is the biggest problem of financial institutions in Europe, of the banking sector, and then we need to do something around it. It's not just about a problem for shareholders. Obviously, shares being at lower value is an issue, but it is the fact that we have such a high cost of capital, how we function in the economy, how we lend to families and businesses that is affected by this very high cost of capital. This has created a distortion on which we need to work towards collectively.
And banking union, is that part of the solution as well in your view?
Banking union is certainly one of the elements that should be helpful to reduce cost of capital. And banking union, and I mean capital markets union as well, we need that size, absolutely. It's not this sole solution, I wouldn't say it's the main problem, but it is clearly an important factor.